Hi, I'm Joel Gilgard with Gilgard Analytics. Thank you for tuning in to this tutorial on global mature bond markets. And this is historical data covering a generation, basically 34 years of global government, both short-term and long-term yields. So we'll be looking at the 3-month government yields of 14 countries, the long-term yields for which is 10-year government bonds for 14 countries, and then we're also going to look at the yield curve ratio for 14 international governments, and that is the 10-year bond yield over the 3-month yield. And then finally the yield curve spread, and that's the 10-year minus the 3-month yield for 14 international country government bonds. And so we'll start out here with the short-term yield index. And so keep in mind, this is not the U.S. bond market, although it looks fairly similar. This is a compilation of 14 international bond markets, and basically created like a global short-term bond market yield. And this covers a generation from 1989 through 2022. So starting in the early 90s, yields were almost 12% on the short term. They went down fairly steadily till about 2004, and then the Y2K, the internet phase, caused the Federal Reserve to raise interest rates. And then basically we had the financial. I take this back actually. I misspoke. It was the real estate boom that caused the Federal Reserve to increase the yields, and they rose up to about 2007, and then we had the fallout from the real estate crash, the financial crash. And then yields went up a little bit. They kept on falling. They fell until COVID. And then last year, when inflation started going up, the Federal Reserve started raising interest rates. And that wasn't just in the U.S., that was across the globe. And you can see here, last year, up until recently, all of these 3-month bills were close to zero. Many countries, they were negative. Japan is actually still negative. But you have South Africa, they're going through some real issues with very, very high long-term unemployment. But you can see here, besides these two countries, because these are the outliers, the U.S. Basically had, at the end of 2022, the highest short-term yields on the 3-month government bills, which is also a reason why the U.S. dollar is relatively high. Next is the Gilgard long-term yield. This is again from a generation. The yield also was very high in the early 90s. This pretty much has been going down steadily until we hit COVID. And then when the government issued stimulus packages around the world, and we ran into bottlenecks with supply chains not being able to meet production. Plus we had the semiconductor issues going on with all the lockdowns. The long-term bond yield has gone up. So we can see, going back a generation, this here is the biggest bump globally on long-term yields. So we can pretty much say that this downward trend in deflation has been broken. Now, there's some analysts that they're saying that the current downtick in inflation around the globe isn't necessarily due to Powell and the U.S. Federal Reserve raising interest rates, but that the global supply chains are coming back in order and are operating similarly to before the COVID pandemic. And here you can see various governments and what their yields are. Japan, again, very low, but they're positive. South Africa, very high. The only country, Western country, that had higher interest rates than the U.S. was Italy, but just slightly. The next graph here is the Gilgard yield curve ratio. It's over a generation. And basically you take the 10-year over the 3-month, and this will give you some very interesting results. And so what you're trying to look at here is how is the underlying economy doing? So is this just your run-of-the-mill downturn, or is there more underlying issues going on in the economy? And pretty much any time this yield curve ratio goes about 5 globally, for sure 10, that the economies are going through some substantial changes. It's not your run-of-the-mill business cycle downturn. And so here, we had Japan went into a depression. Here, after the financial crisis, it was the U.S. that went into what I'll call a modern-day depression. I mean, the numbers, basically what the short-term yield, the 3-month bill, and the 10-year bond pretty much mirrors what went on, what it looked like during the depression of the 1930s. And then, globally, we went to negative here. We had an uptick before the pandemic. And so you can see, Japan currently has a negative yield curve ratio, and that's because it's negative on the short term, and they have positive on the long term. But overall, the rest of the countries, they're below 5, so they're doing fine. Japan is having issues though, and we can see that in their bond market. So here we have the more traditional. This is the Gilgard yield curve spread, and all of what this is I've taken the yields of short-term and long-term government bonds and basically aggregated them, so they'll be similar to the U.S., but not exactly the same, because this will give folks a general good understanding of where both the long-term and the short-term bond yields are vis-a-vis the world averages. So back in the early 90s, we were experiencing some boom times, and so governments around the world, this wasn't necessarily the U.S., they really put the brakes on, and we had a recession around the world, maybe not so much in the U.S., but globally, the yield curve spread was at a almost negative 1, almost unheard of. Anything above 2 means that the banks around the world, they're just letting loose. Banks will do very well here. Economies will start booming. Again, the world tightened up at around 1998, tightened up right before the financial crisis, and then again tightened up in 2019, right before COVID, and now we're almost back to the same position. If we look in 2023 now, it'll be interesting to see what happens at the end of the year, but I bet we're going to go below 0.5 across the globe. And so you can see here, Italy, they've had financial difficulties, since the beginning of the financial crisis in 2008. So it doesn't surprise me that they have a positive yield curve spread. But Canada, Germany, Sweden, the UK, and the US, they all have a negative yield curve spread. And so, their currencies are going to be, stronger vis-a-vis other countries around the world. Next tab here just shows you for each country historically what the 3-month T-bills were for these government bonds. we have the long-term notes, the yield curve ratio. So you can see Japan here, the yield curve ratio was very, very high in the early 2000s. Japan, for all intents and purposes, was in the depression. They're still, they're bumping up. They have negative rates. Japan wasn't the only country, but it's just an indicator. Likewise here, the U.S. Years after the financial crisis, this indicates an unhealthy economy, and we had the beginning of that we saw the same thing happening during COVID, but I think this was just a blip. But we'll see what kind of repercussions all this stimulus has and what inflation looks like. And so here's the yield curve spread. You can see historically what countries had negative. And I don't think, the U.S. back in 1989 did not have any negative yield curve, but Britain did. As a matter of fact, the UK quite frequently has negative rates to combat inflation. And that wraps up this review of global mature bond markets. Hope this tutorial was helpful. If you have any questions or comments, please let us know. Thank you.